This leads us nicely into the second bullet point, which is Comex is becoming a price taker. You'll look at the chart and you'll go, hey, we're going down. Don't be fooled by today's short-term chart chatter. That's all it is. This is the last kick at the can ahead of Basel III US compliance at the end of this quarter. Now, Western gold investments are largely represented by highly leveraged Comex futures-driven speculators seeking to track the price of gold. And to do so, they just have to invest really 4%. And this is a derivative position, which is where you just have 4% of skin in the game. And these are cash-settled investments. They're never designed to be delivered. And they're borrowed from the house market makers. Well, do you figure that's any dissimilar to the synthetically structured world of a casino? I mean, the market makers, the pit managers, loan out this fractionally backed gold, silver, open interest, the chips, as we've said, while taking the other side of these bullish or bearish speculator bets. If they're betting against the house, then the house is on one side. If they're betting with against the house, whatever it is, the house is on the other side. Now, these chips, though, think about it. These chips are not exchangeable outside of the casino. So this is why we called it a siloed market, because everything that you're shuttered in, there is no windows. This is why it's so similar to a casino environment. Historically, this highly leveraged gold derivative structure that could be profitably managed in-house and return a standard 95% win for the house and just enough of a 5% win to keep the speculators trying their luck against the house. Now, this is what led the last 50 years of the gold derivative tail wagging the physical dog price. However, as we've been tracking following the BIS, the Bank of International Settlements, reclassifying physical gold as a first-tier asset class, the global gold price is increasingly being determined by competing BRICS-facing physical exchanges. Now, all the BRICS exchanges require that a gold bar has to be bought, titled to the buyer, and then fully paid for clearly before you can ever offer that for sale. And this is how a real supply-demand globally fungible gold kilobar price is determined by somebody who really is willing to sell it for a price or buy it for a price. There's a balance there. Now, physical market liquidity actually has now migrated to Chinese-anchored BRICS-facing exchange. China anchors these exchanges. China has now become the physical dog wagging the Comex tail, regularly alchemizing the globally underpriced synthetic price, utilizing the backdoor exchange for physical conduit. We talked about it multiple times. It is the way of getting, it's the Achilles heel, it's the backdoor of the Comex where you can actually convert an otherwise undeliverable cash-settled Comex price with only a 4% investment in it into a 100% paid for, physically settled T+1, meaning 1-day delivery, NSFR compliant physical bar. Now, as we looked at really most recently, I think last time, a rush of recent calls from technical traders. They're currently calling for the synthetic gold tail to keep wagging the physical dog, and they're having some success today. What they're doing is chasing moving averages, hunting out, are there any longs or shorts that they can garner at these? This is the house at play. Now, and obviously, while they're doing this, they are either disingenuously talking their own book, which would be officials, spinning the idea that gold should retrace to its historical moving averages and trend lines, which really many people follow. But these trend lines are anchored prior to the 1st of January 2023 Basel III, where it recategorized gold as a first-tier asset class. So the old guard are on the wrong side of an increasingly liquid physical market. And they get little wins, and they're right in the middle, but wrong at both ends. But the open interest, as we've just looked at, is reducing into this process, giving them less and less and less bandwidth to be able to do this. Now, these naked short footprints contradict the strong upsurge of physically settled BRICS gold demand, and they're not going unnoticed. And while these momentums are fueling yet another synthetic market overshoot, done it to the upside, they've done it to the downside, they're providing a very welcome discount to Chinese speculators. And while central banks are price insensitive, they also lay in wait to aggregate their bids below round numbers, which we've just crossed today, where they can fly under the radar, and they step up, then swapping dollars for large gold purchases. And that's something we're evidencing now.
Now, this leads us beautifully into something I've been banging the table about for a long time. The Comex becoming a price taker rather than a price maker. That's a massive shift. It's subtle to most people on the surface, but it's seismic if you understand what's actually happening underneath this paper-driven system. So yes, maybe you're looking at the chart and thinking, but gold's down today. Isn't that bearish? Don't get suckered in by daily chart noise. This is nothing more than a short-term shakeout, the last gasp of the old system, a final kick at the can before Basel III US compliance closes the loopholes and the entire game shifts toward physical pricing. We're heading toward a world where gold gets priced in weight, not in IOUs. See, Western gold investment today, particularly what most people mistake for gold exposure, is dominated by highly leveraged Comex futures contracts. Speculators who want to track the gold price aren't buying gold. They're buying derivatives. They're putting up 4% margin and pretending they own bullion. What they actually own is a bet, loaned to them by a market maker, the house, effectively. And just like in a casino, the house always takes the other side of the trade. You're playing with chips, not gold, and those chips are not exchangeable outside the casino. They don't leave the Comex. That's why we call it a siloed market. It's self-contained, artificially lit, windowless, and rigged to maintain illusion. You think you're trading gold, but what you're really doing is betting against the house with chips that the house loans you. It's a closed-loop ecosystem, and a profitable one for the casino, which historically maintains a 95% win rate. It's the classic bait and tease. Give speculators just enough of a win, about 5%, to keep them pulling the lever, betting more, hoping this time the jackpot hits. But the system's not built for you to win. Now, for the last 50 years, this Comex structure, a gold derivatives market pretending to be a real market, has been allowed to wag the physical dog. But that's changing, and it's changing fast. Back in 2019 to 2020, the Bank for International Settlements, BIS, reclassified physical gold as a Tier 1 asset, putting it on par with cash and sovereign debt in terms of balance sheet treatment. That move didn't just have symbolic meaning, it was the start of a structural overhaul. And now, with Basel III in effect and enforcement ramping up, we're seeing physical markets rise in influence. It used to be that Comex led and the rest of the world followed. But today, the BRICS bloc, China especially, are setting the tone. They're not interested in leveraged trades. They don't want 4% skin in the game IOUs. They want physical, titled, paid for, delivered metal. No rehypothecation, no paper games. And that's the new dynamic, a growing shift away from synthetic contracts toward real, deliverable gold. You want to sell a gold bar in these BRICS exchanges? Great, but first you have to own it. Title must be transferred. It must be fully paid for. No fractional reserve nonsense. That's how a real market operates, with supply meeting demand in a system where every ounce has a home and every bid has a wallet behind it. Let me put it this way. China is now the dog and Comex is the tail. And what does the dog do? It wags the tail, not the other way around. Through a clever structure, the exchange for physical EFP mechanism, entities are able to arbitrage the disconnect between the synthetic Comex price and the real physical price on BRICS-aligned exchanges. This is the Achilles heel of the entire Comex system. It's a backdoor that allows someone to take a 4% margin paper bet, flip it, and convert it into a 100% paid physical gold position with T+1 delivery. Let that sink in. You can take a pretend position in a siloed casino, and, if you know how, you can turn it into actual delivery within 24 hours. That is why the Comex is losing control. That is why the open interest is collapsing. That is why the tail can't wag anymore. Now, just because this synthetic system is decaying doesn't mean it's going quietly. The pit managers, the market makers, are still trying to maintain illusion. They're working overtime to paint the tape, chase moving averages, and create volatility through momentum-based algorithms. And make no mistake, they're still winning some battles, but they're losing the war. Right now, you've got technical traders, the old school kind, pointing at pre-2023 trend lines and saying, gold should retrace to its 200-day moving average. And sure, maybe that kind of thinking worked before gold was reclassified as a first-tier asset, before Basel III, before China became the dominant physical buyer. But those trend lines were etched into a world that no longer exists.
But as central banks are strong price insensitive buyers, they'll just buy at whatever the price. The sell side of this volatility that we're currently witnessing, it really is driven by speculators who are merely racing from pillar to post. They're hopping into safe havens, better buy risk, and then sell gold and bonds, and versus the risk markets, basically, which is what we're witnessing right now. And it's this highly leveraged price sensitive speculators that drive this short-term volatility we're witnessing today. And let's start by connecting just some of these main bullet points, and that under the short-term chart chatter that we're seeing here are driving a series of higher physically supported stair steps. So Shane, let's start with why gold continues to rally without participation from Western investors. So while Asian ETFs exploded into all-time highs in April, now April alone exceeding all of 2024 demand, when weighing up Western demand as a percentage of BRICS-centric physical demand, so one's paper, one's physical, when you weigh that up, the absence of sufficient Western speculator gold market participation continues to actually limit the scope of Comex siloed, officially orchestrated rinses, of which we're seeing today. Now, while we've just evidenced another round of the ebbs and flows of tariff uncertainty, ultimately this lack of easily flushable Comex-centric spec open interest, that's what it's doing, is setting up a perfect scenario for gold to continue to build on its globally determined, physically supported higher stair steps. Now, drilling down, while the PBOC exchanges dollars for gold at every global AM and PM fix, because that's the benchmark where you need, as an auction, you need to have an auction price when you're buying in that kind of size. And so, but they're very disciplined they also know these Comex-centric events, such as non-farm payrolls, FOMC, options expiry events. And while they're insensitive to price, they use this paper-induced volatility to load up official monetary gold reserves without driving the price higher. In other words, they're alchemizing dollar price paper gold into fully paid for physical 400-ounce bars flowing out of London, unrecorded, and that doesn't require reporting requirements, and a lot of it doesn't appear even in the customs data. We once went through how there are something like 40-something custom brokers exchanges, and this shuffling gets deliberately lost. Also, when the generals buy, and generals control a very large amount of gold, official gold reserves, none of that.
Let's pick up right where we left off. So here we are, end of the quarter, and the US is being dragged into full Basel III compliance, whether it likes it or not. What does that mean in plain English? It means the days of the Comex running a casino where 96% of the money is just noise, naked paper bets with no backing, are coming to a hard stop. Banks that were once allowed to park risk-free profits in unallocated gold positions are no longer afforded the same treatment. The regulatory environment is changing the game. We're entering an era where physical gold is king, not contracts, not ETFs, not IOUs. And that means the Comex, which has long dominated global price discovery, is being reduced to a reference price, not a setting mechanism. In other words, the Comex is becoming a price taker, not a price maker. Now, this hasn't happened overnight. It's been building for years. But we've now hit a tipping point. The momentum is irreversible. Let's revisit the exchange for physical (EFP) mechanism, the real Achilles heel of the Comex structure. This tool was supposed to allow arbitrage between the paper market and the physical market, but in reality it's been abused. Western bullion banks have used it as a backdoor to settle obligations off-book, transferring paper liabilities to the London Bullion Market Association, LBMA, where opacity reigns supreme. But here's the twist. The EFP channel has now become a two-way street. BRICS-aligned buyers, particularly Chinese entities, are using the same mechanism to drain physical gold out of the Comex system at suppressed prices. They take the Comex settlement price, use EFP to convert it into London gold, and then further transfer it into Asia, where it's immediately taken off market into long-term storage. That gold doesn't come back. It's not flipping hands again. It's gone. And every time the synthetic price is smashed lower, it just incentivizes more of this arbitrage. This isn't speculative. This is what's actually happening. You've got visible withdrawals from registered vaults, declining inventories, and collapsing open interest. These aren't signals of confidence. These are signs of quiet default. Not the Lehman Brothers, headline-making kind, but a structural failure of trust in the system. Now let's zoom out and consider why this is all happening now. The BRICS nations, Brazil, Russia, India, China, South Africa, are no longer content being price takers. They're building parallel financial infrastructure, cross-border payment systems, settlement platforms, and, most critically, commodity exchanges that price in local currencies or in physical terms. China's Shanghai Gold Exchange is a prime example. It requires real, fully paid gold for trading. It doesn't allow naked shorting, and it doesn't take pricing cues from Comex. In fact, it often trades at a premium, reflecting actual demand and tightness in the market. And then there's the Moscow World Standard, the UAE Gold Exchange, and new initiatives in Singapore and Saudi Arabia, all popping up with one goal: to create a physical market that reflects real supply and demand, not synthetic positioning. This is the future, a multipolar financial world where gold is priced based on who has the metal, not who can print contracts the fastest. And this shift isn't just philosophical, it's deeply strategic. The US used the dollar's reserve status to enforce sanctions, weaponize SWIFT, and control global trade. But now, that trust is eroding, and the countries on the receiving end of those policies are looking for alternatives. And what are they turning to? Gold, a neutral reserve asset that doesn't depend on Washington, doesn't rely on a rating agency, and can't be frozen or seized. Let's talk realpolitik. In August of last year, Russia announced they were ready to settle gas and oil contracts in rubles, and potentially in gold. That wasn't a bluff. That was the beginning of what I call commodity de-dollarization. You don't need a BRICS currency to challenge the dollar. All you need is a trusted unit of account, and gold fills that role naturally. Even more, countries are now experimenting with bilateral gold settlements. India has quietly increased its gold reserves by more than 200 tons over the last 24 months. Singapore, Turkey, Uzbekistan, Kazakhstan, they're all loading up. And these aren't traders. These are sovereigns preparing for a post-dollar trade environment. And guess what? The synthetic shorts on the Comex? They're simply providing a discount to these buyers. That's why I say every paper-driven pullback in the gold price is not a threat. It's an opportunity. For the East, for central banks, and for smart private investors. It's the greatest wealth transfer happening in plain sight. From weak hands to strong hands, from paper holders to physical stackers. But let's talk about the implications for investors watching this today. We're entering an era where gold will be repriced, not incrementally, but in gaps. The current system masks real supply-demand imbalances by using leverage, opacity, and narrative control. But once that mask comes off, once liquidity gets tight and real delivery is demanded, the paper price will have to violently revalue just to incentivize sellers. And here's the punchline. That revaluation is already being foreshadowed. You think gold's recent move to $3,200 was an accident? A one-off? That's the signal. We are now trading in a new range. Forget $1,800, $2,000, $2,200. Those are ancient history. Those levels were for a world where Comex pricing mattered. Now we're in a world where China sets the tone, where real delivery matters, and where 3,000 is the new floor, not the ceiling. And silver? Don't get me started. That's gold's turbocharged little brother. As gold revalues, silver will catch up in percentage terms, and maybe even overshoot. Why? Because the supply chain is more fragile, the market is thinner, and the industrial use case adds a layer of demand that gold doesn't have. But that's another conversation. What matters here is this: the days of watching moving averages, RSI levels, and Elliott wave squiggles on gold are over. If your strategy still depends on the idea that the Comex sets the price, you're already trading in the past. We've crossed the Rubicon. Physical buyers, not speculators, are now the marginal price setters. And that means price discovery is being rerouted. It's migrating away from New York and London toward Shanghai, Moscow, Dubai, and Singapore. It's happening right now. The real gold market is not in your trading app. It's not on the charts your broker sends you. It's underground in vaults, in kilobars with serial numbers, being purchased by governments and billionaires who understand one thing very clearly: when trust breaks down, gold steps in. So don't wait for CNBC to tell you what's happening. By the time it's front page news, the price will already be out of reach. If you're listening now, you're early, but not for long. The game has changed.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.